All right, we should start to see everybody dropping in. Somebody's Tesla is taking notes, I see.
Hmm.
All right. Well, I say we get started. Steve, you ready?
I'm ready to go.
All right. Well, first off, thanks everybody for joining us today. This is the second in our series of webinars focused on EdTech founders. So welcome. And again, thank you for joining us. I'm Keith Harrington, COO and co-founder of Novel Capital. If you're not familiar with us, you should be. We are a non-dilutive funding platform, which is a fancy way of saying we provide debt capital to growing companies who are B2B SaaS companies across the US every day. We actually have a sizable amount of our customers who are EdTech companies. And that's because my co-founder, Carlos Antequera, built an EdTech company called Netchemia for several years before selling it to Vista Equity Partners. So we have a special place in our hearts and our business for EdTech companies. And so I'm looking forward to really digging in to this conversation today. Today we have Steve Kupfer from Reach Capital. Steve, share a little bit about yourself if you would.
Absolutely. Steve Kupfer, I'm a partner at Reach Capital. We are an early stage venture fund that's focused on health, education, and work. Been around for about 10 years. Our fourth fund is a $225 million fund. I joined the firm about 2 years ago, but I've been in the education space my entire career. Started as kind of a combination of CS, AE, product manager before product managers were really things. Was fascinated by all the socioeconomic complexity that school systems offered. Got into the executive search space for a while, so got to see it from kind of the boardroom and the governance level, and then transitioned into investing shortly thereafter, and I've been doing it ever since.
That's great. Thank you, Steve. So today we are going to talk about a couple of things. First, Steve will share sort of the state of the union for VC fundraising and fundraising in general in the ed tech market. We're going to talk a little bit about how and when to raise capital, and then what kinds of capital to raise at various points in the journey. These conversations are always super informative, but they're the best when you, audience members, share questions with us. So at the bottom of your Zoom screen, you'll see the Q&A button. If you have any questions, please drop it in there. We'll make sure that we ask Steve that question and get you some good answers. So don't be shy. Those are always the best questions in the conversation. Otherwise, you're relying on me, which is not great. So why don't we jump in? Steve, let's talk a little bit about the state of the fundraising market for EdTech. What are you seeing out there today? Maybe we talk a little bit about what's working in the EdTech market and what's not working in the EdTech market from your point of view as an equity investor.
Yeah, so at our early stages, we operate in a power law segment, and so it's customary for one company and an entire fund to return the entire fund. And so obviously risk adjusted, we're looking at companies that are capable of growing into those large TAMs. So that's something that hasn't changed. That's been part of the asset class for as long as it's been around. We're looking for outlier businesses that can grow to very large revenue thresholds with relatively minimal capital. And so, the conditions that have changed, obviously, from a macro perspective are, the interest rate climate, the regulatory climate, certainly over the course of the last 6 months post-election. A lot of questions about, are these funding sources as durable as they have been historically? So we've had to kind of narrow our aperture into areas, particularly in K-12 and higher ed, that we know are longstanding, durable aspects of operating those functions. So things like school safety, things like high quality instruction materials, teacher prep, things that are essential to the operating longevity of the business. Even a lot of the non-traditional things like transportation, facilities management. And we've seen a lot of movement in those areas that we haven't seen historically. And so the combination of those factors with the ESSER cliff that has been talked about ad nauseum for the course of the past 3 years, it's a much tighter climate. So our bar has gone up in large part because the bar of those ahead of us that we expect to capitalize the businesses that we're investing in, their bars have changed. It kind of comes all the way down from the top. So our LPs have an expected return, risk adjusted, if they can put more money into private equity or to the public markets and meet their rates, they're going to right size their venture allocation. So that means
Mhm.
less capital. And if anything, given the growth of all of these autonomous development platforms like Replit, which is a reach company, and Cursor, and it's easier to start a business than it's ever been. So there's more businesses out there, less capital. You do the math, and you're going to see the bar go up. So there's certain core areas that are enduring, but there are a lot of areas. Supplemental curriculum is one of them. Anything that is kind of not core to ELA, math, and operating the system from a staffing perspective, it is just much harder to invest in these days.
That makes sense. Just in general, how many deals do you typically see in a year, and how many are you actually investing in per year?
Yeah, so we'll do, and we have what we call a lab program, which is kind of smaller
Mhm.
experimental checks for founders that we think are exceptional markets that we're interested in. So if we take those out, we'll do 8 to 10 core investments a year. If you include some of those labs, which we do many more of, it's on the
Mhm.
range of 20 a year. And so from a funnel perspective, and it's funny, we're going through a process right now where we're trying to use some of these frontier technologies to be better at getting more depth given the velocity of inbound that we have. But we see about 40 to 50 companies a week.
Yeah.
So of those 40 to 50 over the course of an entire year, we'll do 1-2% of those.
Yeah. Yeah. And that's I think common across the not just in ed tech, but that's common across the venture landscape. It's 1 to 2 in 100 that get funded. I'm curious about the lab program. I didn't really know about that. Is that something that so that it would be earlier stage deals, or is that something where it's sort of founder driven? You see founders that you just really want to back, or is it like you have a specific thesis in the market that you want to experiment in?
It's both. So this speaks to the game of venture capital, I think, very well. It started that way, where we kind of said, this is great, founder. Oh, we love the concept, but it's just too
Hmm.
early for us. And then we got to a point where we kind of said, it's important that we're at the table here, and we'd love to be kind of along as they think through some of the pre-product, pre-revenue ideas, in part so we can learn more about what they're working on. And so, we have obviously a better opportunity of leading the subsequent round. And we've gone through kind of this analysis of how that program has performed over time. And some of our best investments have come from that segment, from that really, really early stage. So we've expanded it. We've kind of reoriented it around the larger fund size
Yep.
because it rewards our domain expertise. One of the things that we're most proud of and that our portfolio has shown over the course of the last 10 years is that we feel like we have asymmetric appreciation for a lot of the nuances of operating in this space. Like we should be able to recognize those things sooner. So we should be in a better position to take bets that are bigger than most would take at that stage.
Yeah, that's very cool. You mentioned a few minutes ago that you're always thinking about what are the capital providers downstream looking for, and you have to think about that when you're investing in a business, right? And I think that's one of the things that CEOs of early stage companies, ed tech or not, that's like an added wrinkle, an added dimension that they have to think about. In ed tech and in your experience, are you typically seeing, later stage capital coming from private equity firms? Are you seeing roll-ups? Are you seeing, M&A, IPO? What's the most common sort of outcome that you and the team at Reach are generally thinking about? Or is it there isn't one and it's just sort of you're planning for all of them?
Yeah, of course, when we start our underwriting, our expectation is for most companies IPO. I mean, that's what our LPs invest in us for outlier
Mm.
outcomes. And so I think probably the hardest part of my job is talking to great founders with exceptional, durable businesses that just don't have the profile of venture. And I have to be very um, thoughtful about how I communicate that message and say this can be an amazing business. It doesn't fit a
Right.
venture profile, and that doesn't mean it's not a great business. In fact, it's a better business capitalizing it in a way outside of venture. It's just not congruent for a bunch of different reasons. But our hope, obviously, is that we're getting to companies at the early stages that can get very, very big. Um, for most of our outcomes, they're going to be strategics. And again, that kind of speaks
Okay.
to just our asymmetric appreciation for the environment. We understand where those gaps are, and we know that strategics pay premium multiples than private equity. Like private equity is all about the entry price. Strategics, it's about scarcity value. It's about closing competitive gaps. So our best exits have been to strategics. Um, we think we have a company or two that's in the IPO path right now that we're excited about. We're still a relatively small fund. We haven't had an IPO yet, but our expectation is IPO, high multiple strategic acquisition, and in situations where we feel like private equity can acquire it, and we feel like there's another, run for that company to make. In many cases, we roll a substantial portion of our equity into that acquisition because we feel like that those combination deals can be very accretive.
Yeah, that makes sense. So let's talk a little bit about the market itself. What kind of challenges are you seeing startups have in the ed tech market for fundraising, particularly that CEOs need to be aware of?
Yeah, and I think it's the whiplash of the experience that we've had in 2021, early 22, um, that's gone, and I don't think it's coming back. And so I think this notion of if I get to X revenue threshold, I should be able to raise. Not only is that concept kind of gone, but we're seeing metrics that we haven't seen typically associated with benchmarks at this stage, like revenue per employee. So we've been a part of some AI businesses early on that have gotten to 0 to 10 with like excruciatingly small teams. That's not something that's really been possible in the past. Again, because building software has never been, the barriers to entry have never been lower. Um, that's just a different way of operating. Like we're not, it's a new frontier. And so the way we went from like this era where you had to raise a $15 million Series A because you had to get servers and you had to buy hardware, and there was so much more that went into it. And then we went into this era of just cloud where, okay, it's a little bit cheaper. Now, people that don't have any developer engineering experience can get alpha products off the ground in a matter of hours. So it's like the acceleration creates a totally new paradigm for the early stage where if a company comes to us, for example, and says, hey, like we're raising a $2 million seed, we think we can get to 5 million from one in the next 24 months. We have an engineering team of 10. It's like that's what if that would have been relatively normal 5, 6 years ago. Whereas today, like that you shouldn't need that much resource intensity at this stage to grow. So that has changed. The emphasis on retention has changed. That is a both on the acquisition side from private equity and on the earlier stage. Like if revenue growth is great, but that's fine. But like retention has to be very, very, very high. They were willing to take
Yeah.
flyers on lower retention businesses for a while. So that's another really big piece that's changed. And then I think just the technical stack, the priority on technical founders is something that we've leaned into just because things are changing so quickly.
Yeah.
Not like, okay, it was in React, it was in, you had some static languages there. Now it's like the capability of these technologies is changing on a weekly, if not faster basis. How is your model constellation evolving? Like we used Claude
Right.
3 months ago. Now Grok is much better at that, or vice versa. It's constantly changing. So I think those are 3 or 4 things that jump out as being noticeably different.
That's really interesting. Technologies are changing super quickly. Abilities are changing super quickly. And, for CEOs, it's probably a little bit mind-boggling, just as you described, like this works great for this now, but 2 weeks later something else is better. Do things fall in and out of favor that quickly when you're thinking about making an investment? Um, do you look at it and go, that's so 2 weeks ago? How do you guys think
No,
about staying on that trajectory of innovation?
I think it just speaks to how much value and confidence we put into the ability of the technical leadership of the team to be able to navigate that. Like they have to be able to articulate, you know, it's probably not healthy to be, adjusting your APIs with such frequency that it creates a lot of disruption or risk. Um, you know, Conversely to that, like you could argue, hey, like we have a really diverse model set. So if something does completely blow up, we've talked to companies where we can't rely on one model. It's just like if
Right.
heat goes down for 3 hours and causes a massive disruption to our user base, like that's a huge liability. Like we have to have a plan in place to be versatile. But the credibility and I think, to get really granular into it, like just the intellectual curiosity of the technical founders, they should love to talk. Not only should they know what they're talking about, they should love to talk about it. Because in this climate, like the biggest engineering gurus we know are just elated with the amount of progressive technology that's being pushed out there.
Yeah. We actually have a question from Tesla Haig. And the question is, what qualifications are congruent with venture capital? It's a two-part question, three-part. You mentioned IPO. What other metrics do you look for? And how many of your investments have IPO'd?
So we have two on, we're on our fourth fund. We have two that are on the path. We haven't gone through an IPO process yet. I think that's um, on the horizon relatively soon. In terms of what we look for venture capital underwriting, and this is a great question because it depends on the fund, depends on the size. Like if you raise from a $30 million solo GP spin out fund, the general rule of thumb is that in order to be a high performing venture fund, you need to return 3x net of your base. So in that sense, they need to return $90 million net capital. For the sake of rounding it off, assuming they own roughly 10% of your business, which our goal is to own roughly 10% when we get to exit, do your math. Like you have to be part of a portfolio of companies, roughly 20, 10, 20, 30, depending on how they construct it, that is $900 million of enterprise value. So that's what you have to get to. If you go down the street to Andreessen Horowitz and they have a $6 billion fund, that hurdle has changed because they're more indexing. But if you even take it more conservative posture, 2x net, say that they have to return 12 billion, maybe a much larger portfolio, but you hopefully appreciate like the gravity of the differences between those two profiles. And so if you go to the smaller manager and say, hey, like, I think I can build a really great 50, $70 million business in a smaller market, that could be a home run for them. If you go to a much, much bigger fund, I could be like, that doesn't move the needle for us at all. Like, it's got to be an enormous market, consumer, global, which is why you see, the deals get done, that get done. So total addressable market, if it works, how big can it get? I think that's probably the hardest thing for us as investors is when things work, the motion works, which so often you have to experiment for months, if not years, to figure out what works. If it works, we want the opportunity to be big.
Right.
We don't want to have to sacrifice the size and go into a totally different market or totally different go-to-market motion. So total addressable market, big. The ability to grow, the general, like the adage is 3x, 2x, 2x. Like, at seed, can we see a company that can grow on that steep curve is a good early indication that you have the velocity to grow into a big size, and you're not going to need a ton of capital to get to the next site. Because if it costs you $80 million to get to a $90 million run rate, that's very, very different than if we can get to that run rate on $5 million
Oh, yes.
already involved. So the ability to pursue those really big markets in ways that don't require an enormous amount of capital are the best profiles for venture capital.
Yeah. Yeah. That's a great answer. Thank you for that. We have one more question that I'll lob up for you here. This is from Andy. Going back to your lab program, do you plan to continue to work with research orgs to accelerate the development of your lab program companies?
We're thinking a lot about that right now. I think we're thinking in general about, how can we better collaborate with the ecosystem to cultivate at the earliest stages. Like we work closely with the teaching lab here in New York City, who feels like they have a really strong pulse on what great classroom pedagogy looks like. They really understand how curriculum has evolved, how curriculum and assessment as integrated parts of the instructional cycle has evolved. They feel like they're really well positioned, better, more so certainly than your generalist pre-seed investor, to identify great founders and problems to work through. And so I spend a bunch of time with Sarah. What are you seeing? What are you feeling? What are themes that you want to put out there? What CEO profiles are you looking for those businesses like that? To be able to identify them at those earliest stages, build
Mhm.
relationships and trust and credibility, and being able to add value to those founders in a variety of ways, whether it's early hires, whether it's giving them benchmarks. Just as a concrete example, was the founder yesterday. What should my cohort retention on a month one, month three look like based on where I'm at with about 1,000 users? Like, what's good? Where should I be green lighting, going faster? Where should I be stopping and saying, okay, I need to fix this. This is
That's
not
incredibly useful. Yeah.
not effective. And we'd be surprised how many founders we see who show us exceptional performance and say like, am I doing okay? Is this good? And we're like, this is incredible. And other founders that say, I am off to the races, like get on the rocket ship. We're going to the moon. And we look under the hood and it's like, you're spinning your wheels. Like you're churning out as many users as you're acquiring. So that is like a really good example of collaborating with those research orgs, hatching ideas really early on, and making sure they're being as efficient as possible with their learning process. Our
Yeah.
goal primarily at pre-seed and seed is learning velocity. Like how quickly are you learning? Are you
Yeah.
learning a lot on a week-to-week basis, or does it take you a quarter to kind of
Yeah.
understand the mechanics of your motion?
You've said you've mentioned a couple of times churn retention, and I think at the very earliest stages, a lot of CEOs don't really understand just how critical it is to watch that and to optimize for retention. Because I don't know about your experience, but in my experience, once churn starts to exceed a certain rate, it depends on the market, but there's just a point where it's really hard. It's very hard to stop that leaky bucket.
Yeah.
When you're working with founders, is that one of the things that you're most focused on?
The way that I position that to them, Keith, like, and we take a lot of pride in the empathy and the respect we have for the courage that founders bring to the table.
Mhm.
And so the analogy that I have been using recently is, when you have major churn problems, like this work is hard enough, first of all, like taking the
Yeah,
plunge. You could have a secure job at big tech or a consulting firm. Like you've chosen a path of like grave uncertainty for the large reward at the end. And so that's hard. Now imagine like your heart rate's at 180 and you're running 20-minute miles. Like that's what bad retention feels like.
I like that. I like that.
You know,
Yeah,
like you are working your tail off to acquire new customers and you're not really making any progress. Like if you're churning
yeah,
30%, you have to acquire 30% more to get to where you were.
exactly.
And so, like the law and something that or very early in my career was super productive to illustrate this was looking through the compounding effects of strong retention or
Right.
not. And I remember just looking at the chart and being like, holy cow, the difference between like 80% retention and 92%
Yeah,
retention, maybe 12 points at this moment in time, but over 5 years, it's staggering, like
yeah.
how much it compounds. So it's unsurprising then that
And the reverse is true. The
that's
reverse
right.
is true. Yeah,
Exactly right. It obviously works in both directions. So it's
yeah,
it it's unsurprising then that we see second time founders, particularly like I'm not racing yet. Like I
yeah.
gotta wait until we get retention to this place because I don't want to run 25 mile. Like I don't want to run 25-minute miles with that heart rate.
Right.
I want to get efficient. I want to feel like I'm making progress when I'm acquiring as opposed to
Yeah.
just a liability.
I love the analogy there. That's excellent. I might steal that from you, but I'll give you credit. Um, so let's talk a little bit more about the macro situation. Uh, Things are crazy. Nobody knows what's going to happen next in Washington. What kind of turmoil are you seeing? How how are you thinking about? Maybe that's the right question to ask. Really, how are you thinking about uh, funding sources going away, the potential of the Department of Education being hacked away? How do you think about that as a risk in the market?
Yeah, so I'll start with some context. In my executive search days, I was given a very ugly view behind the curtain of just how political this work is. And so I've always been enamored with just the political nature of this segment and like how the politics of the bureaucracy at the local, state, and federal level are all dynamics that you have to have a pulse on. And so from the very beginning of my investing years, and certainly when I joined Reach, we were underwriting deals with the understanding that this has to be able to traverse two very different administrations. I mean, 3 years ago, we were saying, like, does this fly in a scenario where the Department of Education gets abolished? Which people kind of laughed at me at that point. I was like, this is red meat. It doesn't have an enormous impact on the local and state level as much as many people might think it does. And so here we are, like, thankfully we've planned for it. And I think what I would say to founders is the federal revenue streams are relatively small. Like it's 5-7% of the overall funding. The vast majority of it is local and state. And so what we're steering our founders towards is having a much more meticulous approach to what states you're going after. And just to give you some like really like softball examples, like if you're an
Mhm.
SEL curriculum, you probably don't want to be in Florida right now. If you're a religious-based curriculum, like you probably don't want to be in Connecticut and Massachusetts. Like there's just certain political dynamics that you want to avoid. And so you have to have your pulse on and that's always been true in education across the board. I think what's different now is if some of those big federal funding streams like Title I, Title II, Title IV get block granted down to the states, obviously, like you don't know how those states are going to handle that. Some states may supplement it with more dollars from their general budget to support kids with disabilities. Other states may use that as a slush fund for other political needs that are, of expedience to them. And so I think we're steering them towards, it's kind of more symbolic at the federal level. I think this
Yeah.
administration wants to do a victory lap. I think they want the optics, they want the theatrics with it. But from a practical perspective, it doesn't have too much weight bearing on the funding that goes into the system. It just changes the direction they come from, which will be more from the state, which is going to be more subjectively used as opposed to being enforced by the feds. I think the only thing I'm really concerned about, which I've shared with you previously, Keith, is like the Office of Civil Rights is in the DOE, and they're in charge of making sure that states are serving all kids and serving all kids
Right.
as legislation requires. And so if that goes away, if I'm a parent of a child with disabilities, or if I'm running a special ed department, or I'm a community-based advocacy organization for students with special needs, that's really scary to me. But beyond that, I don't think the average early stage business or even growth business, frankly, is going to feel too much from this.
Yeah, that's great. Great context and great insight. Thank you for sharing that. A lot of the ed tech founders that I talk to have questions about it, and certainly other funders in the landscape or in the ecosystem um, have a bunch of big question marks over their heads. So it's good. It's good to hear how you're thinking about that. Let's switch over to the new topic. I see we've got a question from Rajit, which I will ask here shortly. um, But let's talk a little bit about raising capital in the edtech market when it makes sense to. I mean, everybody who's an edtech founder, everybody who helps edtech founders, everybody who is in the edtech market in one way or another knows that it's highly seasonal. So is it is the cash flow dance that ed tech founders have to participate in? Is that, Steve, something that you see change over time as a company gets larger and grows into subsequent equity financings or series of financings, or is that just something that it starts with day one and you have to get good at it, and it is just something that you have to remain good at? Maybe just the magnitude of the problem changes.
Yeah, it's a muscle that you just have to build. And so I think one of the reasons we've enjoyed working with novels that it's native to your DNA. Having
Yeah.
Carlos having worked through that for many, many years. Um, it's something that we have to educate other investors on that we co-invest with who aren't education specialists when they look at the nature of the cash flows. They look,
Yeah.
they pull back, they're like,
Right.
I don't understand, and so we have, of course, always looked at it as an asset as opposed to a liability. Like if all the enterprise mainstream SaaS companies automatically got their balance sheets reloaded every July, most of the time with a cost of living increase, like that durability would be admired by
Yeah.
the market. We have that luxury. This is very durable revenue. Is it super hard to acquire? Is it fickle? Is it really local? Is it highly regulated? Yes, but like that durability is something that we look at as an asset. And so if the cost of that durability is seasonal cash flows, then we need to have solutions that recognize that. And, that's a problem that Novel and providers similar to you have recognized, that when our companies get into that cash trough of, early spring, late spring, but they're going to be flush with POs come July 1.
Right.
If you have a couple choices, you can pull way back on your investment in growth, or you can find someone for a reasonable cost of capital that's going to bridge that for you. And so, of course, in our business, we don't want to have to pull back and say, like,
Right.
don't hire those salespeople, particularly since that's the time of year that we need those people.
Exactly.
We have to make those upfront investments in September, October, November, so that they're ready to go when budgets are being made in the first quarter and contracts are being executed in the second quarter. And so, of course, we have first-time founders all the time saying, like, I got to do this, this debt dance again. And our hope is that they build long-term relationships with people that understand the nature of their cash flows,
Yeah.
that have a pulse on the seasonality of their business, whether that's acquisition or renewal, and get comfortable with the underwriting much faster than going to like a small bank who just gets dizzy very quickly.
Yep.
Looking at these cash flow statements, like kind of having to reorient themselves around that.
Yeah.
So it doesn't go away. It shouldn't go away if you're growing really nicely, because again, you want to continue to front load that investment, assuming you have high levels of retention and reasonable growth.
Yeah. And just a shameless plug, Steve, you mentioned that you and the team and your portfolio likes working with Novel, and I mentioned at the outset we've funded a good portion of our client base is actually EdTech companies, and it is exactly for the reason that you described. It is in our DNA. Carlos, as the co-founder of the business, just he had to power through and understand that cash flow dynamic, and that's part of the reason that we built our financing instrument, our funding instrument, the way that we built it, because we understand that in a highly seasonal business, we need to be prepared to actually provide capital that is going to be useful and not extractive when the days get lean. But I think it's an incredibly unique feature of the market. We see it in some other verticals as well, but in EdTech, it's remarkably pronounced. Questions are rolling in, so I am going to ask them. The first one from Rajit. When you think about investing in ventures related to K-12 USA education, do you have a strong preference for private versus public education, knowing that the vast majority of students attend public schools? How do you think about this? TAM, stability of school funds, regulation. We touched a little bit on that before, but
Yeah, no, I can get to that one pretty quickly. So I think you kind of you say it in the question, like public ed's just a huge part of the TAM. So we see privates as more of an experimental early stage R&D ground, because procurement's much less difficult in those independent schools. Like for the most part, you can get straight to your buyer without too many layers. And then in terms of um, regulation and all those things, like there's benefits there, obviously, but not at the expense of TAM. Like most of the time we see early state, like pre-seed, hey, we have a handful of independent schools, great. That's like you're using that to hone the product, better understand the personas, but you got to learn how to distribute through K-12. And distributing through public K-12 is just a totally different beast. It's not the same playbook. And so we're not going to do an investment in a company that only has independence. And that also just kind of speaks to the equitable side of it. Like we don't love doing consumer facing ed tech for K-12 either. Like we don't want parents to have to be able to afford something in order for to get access to it. We like the durability of these revenue streams. We like the accessibility for all kids. We like the size of the TAM. And if you go to independence, you lose a lot of that.
That's
In
great.
terms of the next question around, good businesses that aren't appropriate for venture capital. I'm sorry, Keith, I'm taking your stage here.
Oh, no, no, this is your stage.
What does Reach Capital typically look for at the pre-seed stage? Specifically, is it important to have retention metrics in place, or are there other factors you'd prioritize at the pre-seed? Honestly, at the pre-seed, it's two things. Its team is probably 85% of it. Nothing else matters if it's not the right team. It could be a great idea, incredible market. If it's not the right founders, and we're signing up for a 7 to 10, if not 12 to 14 year run with that team. So that's not a negotiable. We don't switch out management teams. Like that is an absolute like last resort scenario. So we have to look at those founders at pre-seed and say, you are going to have the fortitude, the resilience, and the willingness to embrace a volatile, uncertain building future.
Hard.
That's a huge part of it. Like, are you going to crawl through tunnels to figure out why what you're doing isn't working and what will? A lot of our best companies, like what they ended up being very successful at was nothing like what they started at.
Right.
And so like that resourcefulness to be able to get through it. And then I think the other thing at the pre-seed stage, you hear like the very typical um, pushback from founders is like, I can't deliver on this stuff if I don't have capital. Like you can't ask me to do these things if I don't have capital. And like I have to say, it's difficult, but like that's part of the test here, resourcefulness and like figuring out a way to do things when you don't have all the resources is kind of it's the first gauntlet that you have to go through. And that's I would say in large part why the conversion from our top of the funnel is so small because there are very few founders out there. It's an outlier characteristic to say, like, I don't care if I'm gonna hack a bunch of solutions, prototypes together just to better understand the problem that my user is facing. If you need $2 million to figure that out, that doesn't fit the first qualification of resilience and resourcefulness.
Yeah, and I might just comment on that as well. Capital is actually very rarely the problem in my personal experience, not my experience as a funder, but as an entrepreneur. It's can I prioritize and pick the right most important thing to work on and then solve it, see it through to completion. And that is one of it is the hardest thing actually. Because it's a grind, as every entrepreneur knows. It is definitely a grind, and it has its ups and its downs. But you have to have the fortitude, like you said, to keep on going. There was a piece of that question that I want to touch on. What would you advise founders to reflect on as they're weighing the question of whether venture capital is the right fit for their business? There's certainly there's a whole bunch of stuff wrapped up in that question, I think, but you probably
Mhm.
get this question like, should I be raising VC at all? How do you talk to founders about that?
Yeah, I think it's a combination of are you willing to go very fast?
Mhm.
Are you comfortable doing that? Like there are some founders that are wired to do that. They don't have any other mode. There's no gear. It's I
Yep.
just go 100 miles an hour, and that can become a liability, to be sure. Like sometimes that speed comes at a cost that is detrimental to the net value of the business, no
Yep.
doubt. There are other founders that the thought of having a 5-member board at Series A with very different fund sizes to the previous point, very different incentives at very different points in their fundraising, all asking you for maybe things that are in line with their self-interest. And in this climate, you see that with relative frequency. Like the smaller funds will be like, hey, pump the brakes. Let's revisit some of this retention stuff. Let's maybe think about some of the product retooling. And the big fund is like, that doesn't help me. Go
Mhm.
faster. We'll figure it out. Keep growing, keep taking on contracts. And so I think part of it is cultural. Like, does the notion of that give the founder energy, or does it really stress them out? And I think they have to be intellectually honest about what the answer to that question
Yeah.
is, because we have tons of examples, as an angel, a ton of examples of founders that were like, I'm just not built for that, and had incredible outcomes
Yeah.
for them personally. Because you
Yeah.
said, like, I'd rather build this thing over 10 years, not have someone prioritizing my roadmap and my incentive structure for me, having to approve all these things. I think it's what you're built for. And that's kind of, you only have that option to go fast if it fits the parameters for venture, obviously.
Yeah. Yeah. There's no going back once you take on a bunch of venture money and you have a
Right.
board.
That's right. It's so unsurprising again that you see a lot of second time founders like, I'm going to raise as little as I need to like prove this thing out. So I maintain optionality. And if I feel like, okay, I've gotten to a point where I have a lot more confidence, that you don't see second time founders often raise like massive amounts super early because they don't need to, they don't want to.
Yeah. Yeah. That's great. Vance, I see your question. I'm going to get to it in just a minute. I want to kind of round out this topic. Uh, as part of the journey, CEOs are always going to have to be raising capital in between rounds, right? They're going to go out and they're going to have to raise bridge rounds, the proper pre-seed, seed, Series A, Series B. There's a whole bunch of stuff that happens in between that, right? So what are you advising CEOs today to do between the rounds that you're going to typically write a check for?
So milestones, basically, like
Yeah, yeah,
milestones in between rounds.
yeah,
Uh, Yeah, I mean, since we primarily operate at seed and Series A, a big part of this discussion happens in diligence. And so, just for the sake of, actually, this is a perfect example for this discussion. And we talked to a business recently that pre-seed wants to raise a million, million
mhm,
five.
mhm.
And, I said, why a million, million five? And they said, well, gets us to a year from now, January. It's K-12 business. And so I said, okay, well, the milestones that would get us to January, how does that help us in revenue generating season in the spring?
Right,
If you're going out to raise in January, that's the time I want you focused on knocking down deals,
right.
talking to customers. I don't want you out fundraising in January and February. That's not great timing. So like, let's recalibrate what you're raising bottoms up to get you to June. So when every teacher and every admin goes on vacation, okay, now you can go out and raise some money,
Yep,
or push that to September. Like the timing is really important, but underwriting bottoms up. Okay, like what resources do you need? Ultimately, our job is to get you to the next milestone in the most capital efficient way possible. So we have to stress test those assumptions on the front end. Like we're going to get to this, this, and this. Okay, well, how many engineers are in the budget for that? Two. Okay, I think you need six in order to do that. What's your sales motion look like? Is it sales led? Is it product led? So we do a lot of that on the front end, but ultimately, like in a worst case scenario, if you don't underwrite that correctly, you're going out to, you're raising the seed two, the seed three preferred. And then
yep,
with every extension, or we'll extend the safe, but we'll raise the cap a little bit. And like with every passing, raise with that profile, your cap table gets a little bit more difficult.
yep,
You get to Series A, or when you do get to that milestone, the investor's like, okay, you got four overhangs of different caps.
yep,
Who is this that, it's messy. And so we prefer to be as clean as possible. And obviously, you build in some buffer to set those milestones in a way that is reasonable. And
yeah.
both the investor and the founder can look at and say, yeah, I think I can deliver on those milestones with these resources. If that's out of whack to begin with, then you're betting on luck, basically, to fulfill your underwriting.
Yeah. Yeah, and I think for anybody who hasn't been through the experience of having to convert multiple nodes that are stacked on top of each other, it gets very complicated. And we see entrepreneurs often totally surprised by the amount of dilution that it actually carries with it. A lot of the entrepreneurs, especially EdTech entrepreneurs that we work with, are in between rounds trying to get to the next milestone. and they take capital from us because it's non-dilutive, and then they don't have that overhang, and it's cheaper in that sense, and that it's not equity capital. Um, let's talk a little bit about that actually. How to think about the right kind of capital to raise. The question that we have from Vance, I think, is perfect. Um, and he asks, where do you look for equity if ARR upside is more limited, say 10 to 50 million? So I assume he's saying, I think I've got $50 million of ARR opportunity, up to 10 to $50 million in ARR opportunity. Where should I look for equity financing? Um, Steve, I'd love to hear your take on that. I certainly have a point of view.
Yeah, I mean, you got kind of your very traditional, like, okay, you can bootstrap. You can, I
Hmm.
think our most resourceful founders, and there's some, fantastic stories. The Study Island guys are probably the case study in K-12 for, bootstrapping something for like 80 or 90 million in revenue, basically owning the entire thing, not getting diluted at all and selling it, relatively speaking, for just an outrageous gain. So bootstrapping is the obvious one. Like we see really resourceful founders that have a combination of product and commercial capability to get customers to pay in advance and say like, hey, if we can build this MOU, I got a cohort of 5 of you, let's say. And like if you, for the sake of an example, like in K-12, hey, there you got these 6 districts with very similar problem on the outskirts of St. Louis. Like if you each put in 10, I can build this V1 and have it ready to pilot in the spring. Like we see that with relative frequency. Those are special founders because they're selling something they don't have, which in K-12 is really, really difficult. So the pain has to be really acute. So that's one option. I think the most common option is just much smaller funds, like funds where the underwriting works. There's been a crazy proliferation of single digit spin-off funds because it's so easy to manage funds through like AngelList, and there's all these platforms now that allow you both rolling funds and closed-end funds.
Yep.
So there's an enormous, but there are people that were, man, if you get to 50 million, like that is an incredible outcome for that fund. Again, so there's been a huge population of that. So we have like a spreadsheet going around with like every sub-million or sub-$100 million fund in the ecosystem. I'm sure there's lists that are, sub $20 million funds. And so really identifying that and appreciating that the underwriting is going to be much more compatible for them than the bigger funds. And those are the 2 most common paths that we see.
Yeah. And I would add on to that, and say I think the first question I would ask is, do you need equity? I think that's the very first question. A lot of the entrepreneurs that I talk to, that's what everybody's taught. It's how we're hardwired to go find financing for a business is I need to go raise equity. And as Steve has pointed out a couple of times, not every business is a great fit for VC or for equity, and in particular for VC equity. So depending on kind of what you're trying to build and what outcome you personally are shooting for, I think that's what drives and should always drive the question of what kind of capital do I need to go raise. And it may very well be that I'm not going to raise any kind of capital. I'm going to bootstrap this thing. It's going to be a lifestyle business, and I'm going to grow it, and I'm going to love my life. Or the other extreme is I want to light the fuse and really move as fast as a human can move, and I'll go raise VC money to do that. And what we see is a lot of companies have this incredibly fast growth trajectory, and then they sort of plateau, and then they grow very quickly again, and then they kind of plateau. And it's a very interesting dynamic. And a lot of the entrepreneurs that we talk to are in between venture rounds. Some of them are totally bootstrapped. Um, and the capital that we use helps them get to the next, or that we provide them helps them get to the next milestone. We have a ton of our companies who are raising capital on better valuations as a result of the fact that they were able to get non-dilutive money from us, which we love. That's why we're here. That's exactly what we want. Um, and we have another basket of companies that are totally bootstrapped. They asked the question, do I want equity or not? And their answer was not, I don't. I want to build this thing with what I have at my disposal. They get to
Yeah.
a certain amount of revenue, 500,000, 1 million or whatever, and then they can take on some capital from a company, from a provider like us, and really accelerate without taking dilution. So that case study that you shared, 80, $90 million in revenue, and they're totally bootstrapped. That's an incredible outcome.
Yeah, I
That's
mean, it's
amazing.
total. it's a total outlier, obviously, but I think,
Yeah,
another dimension to that concept, Keith, is it has to also respect the reality of the market your product is operating in. And
exactly.
I'll give you a really good example. Like all these classroom co-pilots that have emerged over the course of the last 2 years, there were some founders that said, like, I don't want to take a product-led approach to this because that's going to require venture capital. I'm going to
Yeah.
just go slower and steadier. I'm going to bootstrap it. I'm going to just and it's really, really hard to compete in that market with that
Mhm.
model. Like
Yeah.
that model requires a high K factor, a lot of virality. Like the first mover, when you lock in a teacher and they have a ton of their content in your platform, is really valuable. And if you're late to that, it's not like that. That's a risk that's kind of like you have to take if you want to compete in that segment. Taking a bootstrap approach for a business like that, like it's going to be really, really hard to compete. You're going to have to be comfortable with a very different outcome. Whereas if you take more of like we have a lot of companies that start with a services wedge. Like, okay, as we build it, like pay us, particularly school districts are great at paying for service. Like
Mhm.
85% of their budget is services. So the PD budgets, oh, like, yeah, if it's something that we can touch and feel and experience, from a service perspective, yeah, like, we got budget for that. So they'll use that often as a wedge to subsidize the development of software, but just
Mhm.
respect what you're going to be competing against, and certain segments are going to require, much, much more capital on the front end if you want to compete on the back end.
Yeah, that's great. We are coming to the end of our time. Anything, Steve, last minute words of advice, bits of wisdom that you'd like to share with the folks on the call?
I say the same thing every time somebody asks me this question, and I'm not sure exactly what the profile of our audience is here. I'm assuming there's founders on here, but I just always try to make a point to thank founders. Like they're the ones that take an enormous amount of risk. They embrace a level of discomfort that I think most people don't have an appreciation for. And as a result of that courage, like we have the benefit of so many of these products that are out in the world that are delighting users every day that in the absence of, we wouldn't have. So thank you to the founders that are, pushing themselves to the edges and embracing that discomfort. And thank you for, all the people that support them in that effort. That's something we take really seriously every single day.
Yeah, thanks, and thanks for saying that. That's I think that's very very well said. As a co-founder of a venture-backed business right now, I can empathize with this. It is a difficult, rewarding but difficult road. So I have a lot of empathy for the founders on the call. Um, Sophie, maybe we could pop the slide up with our contact information. Steve, I assume it's okay to share your contact. Too bad, we already just did it.
Oh, share it to everybody. Share it far and
Yeah, okay,
wide.
good. Same. Anybody on the call, you want to get in touch with Steve? There's his contact info. We'll share this in the materials that we send out after. You can always reach me directly at my email address, which you can see on the screen. Thank you, everybody, for joining. This was a really rich and interesting discussion. I hope everybody learned something today that will help them on their capital journey going forward. And Steve, thank you so much. This was a great conversation.
My pleasure, Keith. Thanks for having me.
All right. Thanks, everybody.